Anytime our next guest does remain bullish overall, believes large caps will continue higher, describing the current backdrop as softilocks with a moderation in both economic and inflation momentum. Joining us here at Post 9 is Piper Sandler Chief Investment Strategist Michael Kantrowitz. Michael, it's great to have you back. Welcome.
Thanks, good to see you.
What is softilocks?
It's the cousin of Goldilocks, perhaps. Goldilocks is stronger growth, lower inflation. Softilocks, which I think would be very welcomed by the market, is slower growth and moderating inflation. So things that we typically look for in a slowdown, but when everyone's worried about inflation, there's good news from softer economic activity.
How do you ride that rail and avoid growth scares?
Yeah, well, that's the concern, I think, especially in the last 2 months as the unemployment rate has reached 4%. You're starting to see a shift, just like the Fed is talking about a shift of the risks being more balanced. Inflation's not out of control anymore. Unemployment is rising, but still very low. And so I think we have to, observe the data, all of the labor market, watch how earnings evolves. And we think we're kind of in the sweet spot right now where there's not a huge risk around imminent recession, the economy falling off a cliff, and we're enjoying the benefits of disinflation.
It sounds like, though, you think that NVIDIA is going to rule the markets until after the Fed cuts several times. You say that you don't think that there's going to be a broadening. You're negative small caps, and you don't think there's going to be any sort of a broadening of the market until the Fed has cut many times.
Well, I think to the extent we're going to get a broadening, we got it. It was last November and December. Small cap valuations, so the S&P 600 went from 12 to about 15.5, where they are now. So they're no longer cheap. To really get true sustainable broadening, it's always about one thing, and it's always about earnings broadening. And it's difficult to get that without the Fed cutting rates after a tightening cycle.
And your work keeps bringing you back to this quality theme, right? Yeah. So quality companies, it seems as if that is what the market has been wanting for a while and has capitalized at a pretty high rate. So I guess at what price do you keep wanting to bid for quality?
Well, so I don't think it's so much about valuation. Investors are buying quality companies for all the right reasons: better balance sheets, better income statements, better cash flow statements. So I think it becomes at what catalyst does that shift? Mm-hmm. So either a broadening out of earnings, or if we get a broadening out of weaker economic activity, then equities broadly will get hit. But in that backdrop, companies with better fundamentals are typically still outperforming.
And I guess the question, I know you do it more on an equal sector weighted basis, right? That's what you prefer to approach it. But it seems as if a lot of the quality approach would sort of ratify just by the same handful of names, right? Because all the mega caps have all the earnings momentum, the best balance sheets, and all the price momentum.
Yeah, and if you look at one of our favorite ETFs, the way to express that would be QUAL, Q-U-A-L, which is about 50% tech.
Yeah.
So there is obviously sectors with better fundamentals, but when we're talking to institutional clients who are in small cap world, mid cap, large cap, even value investors, it's the same themes that are working in all of these groups. Larger companies are working within small caps relatively. Mm-hmm. More profitable, faster growing companies are working better within mid caps and within value. So you can't only own 6 or 7 stocks, but you want to own those same attributes that those companies that are leading have.
I would imagine those folks that you're talking to in terms of the value and the growth sort of portfolio managers, investors, there's a lot of overlap these days. Is that right? I mean, that the value folks are also in NVIDIA. They're also in those handful of stocks. I mean, and that sort of speaks to the momentum behind this trade. Now, I mean, do you see that overlap as propelling this trade higher or making it more dangerous?
Yeah, in a sense, the weaker parts of the market have been kind of pure value and pure growth, which are kind of the riskiest parts of value and growth. And so quality exactly brings value and growth investors kind of in the middle, looking for profitable value, profitable growth, and a lot of those larger cap names are in both indices.
Some of your work looks at various silos of inflation or disinflation. You look at motor vehicles. Do you have a call on when insurance and shelter kind of play game?
Well, we've seen the month-on-month OER rent continue to slide lower. Our economics team thinks that's going to continue, that perhaps last month's CPI report was the end of the acceleration in some of these insurance-related items, and that's really the only thing holding things up.
I mean, people talk about there's two things, right? Yeah. Shelter and insurance, and the thinking was that shelter insurance is beginning to crack. You don't have a problem with that one?
No, I think that's right, and if this continues, what we saw last month, it's going to be really hard to print a core inflation month-on-month level more than 0.2. going forward. So I'm not saying it's going to persist every month to this magnitude, but when the unemployment rate is rising, it's time to start looking beyond inflation.
And do you think that those dynamics with the unemployment rate rising, I mean, people are starting to, raise some alarms that it's going to get away from us or the Fed's going to get too cute and wait too long?
Yeah, no, that's the concern. I've been hearing now for about 2 months. And it is true that typically the unemployment rate starts to go up slowly and then goes up quickly. And if you look at the last 8 recessions, back to 1960, I think we can look at each one of those and say, well, what was going on that perhaps tipped the economy, or really what broke and led to that acceleration? And there's always risks today. But one of the things that's not present, which has been present in most of those, is a big spike in oil prices. Oil's very well behaved today. And then we have, a flexible labor market. We have this fiscal spending that's helped offsetting the impact of higher rates. So softilocks is also a slowdown, or call it, not a recession, but a slow softening. Sure. So if long as that it continues at this moderate pace, I think it maintains a good backdrop for equities.
Finally, how do clients express their interest or concern about election uncertainty, either here or UK or France, and geopolitics?
Yeah, well, it's on the wall of worry. There's definitely we've seen a lot of volatility now in Europe because of these elections and emerging markets, and of course we've got an election coming up. I think there are so many other things that are, especially for U.S. markets, that matter imminently. What's the data going to be tomorrow? What's the Fed going to do next? What's the unemployment rate going to be? The beginning of the month. And so I think that's going to become more in focus as we get past, closer to Labor Day. But it's becoming a growing concern, but still something that should be played at the idiosyncratic level rather than the market level.